Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been America's foremost precious metals brokerage firm since 1972, helping you build a strategic precious metals portfolio. Call 800-525-9556 to buy gold, silver, platinum, or palladium today, or go to McIlvaney.com. Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets with a optimistic look ahead into the week and coming weeks, if you will. We're joined by Rob again today. Always great to have you, Rob.
Thank you, Tori.
We're excited, though, to first get started. Miles, throw you under the bus a little bit. Prices bounce around. You get on the hot seat, and everybody wants to see your chart. So let's start with the gold chart.
Yeah, the unfortunate nature of my position here is being the current youngest person in this room, I am the oldest curmudgeon and most pessimistic person as well. So
hang in there. You two will get the wisdom.
I'm trying the wisdom of just eternal optimism. So, well, I will start the day out just a tiny skosh of optimism, because gold has been quite optimistic for a while now. And I was hoping to see, only from a trading standpoint, not because of the direction I want gold to go, but just because the purity of the charts themselves. I was hoping to see gold come into that top end of the chart back in November and give us some sort of semblance of a reversal back down, which it did. We're looking at gold coming from 1875 all the way down sub 1800, a pretty significant move. The problem with gold, though, is it failed to put in a lower low. And then you know what? It failed to put in another lower low and another lower low and another lower low. And lo and behold, here we are at the top end of our trading range again without making any significant push down towards the bottom end. So once again, I fear saying, as a chart guy, I'm always terrified of that big, terrible B word, breakout. But it is very possible we could be seeing gold really bumping against that ceiling, looking for a crack to push through to higher pricing. One thing I have brought up in the past is you look at Elliott wave theory, and you're looking at continuations or sideways trading. Oftentimes when you see these triangle patterns, it's usually somewhere between the 50 to 70% of time duration. So if you look at the chart I've got on the screen now, kind of showing how long this whole triangle could potentially last, we're about halfway or a little over halfway done. So whether we're going to break out to the upside or the downside is probably going to happen pretty soon here.
So what do you see as some key resistance levels? Because we are stepping our way up here, and I'm with you. I'm most encouraged by gold. Call it a subjective sense for bullishness, just because gold's sitting here, Rob, and you've been here long enough to be like, hey, this is different because we do have a stable, if not strong, dollar index. It's not like the dollar's turned down. The equities markets are hanging in there somehow. Hawkish talk from the Federal Reserve. The Federal Reserve is tapering. All of those things, normally you would think gold would be coming down, but it's not. It's inching its way up. So that being said, Miles, what do you see as key resistance?
You know, I'm glad you bring that up. It's important to remember that just because you have a ceiling doesn't mean you can't change the ceiling. And we talked about this a couple weeks ago. We had a descending wedge top that got pushed out and got pushed out again and got pushed out again, and it just keeps stretching the timeline out. What we haven't had happen yet is a significant higher high from one of these previous tops. So if you ask me what are some key resistance levels, there's only one I really care about right now, and that's the high back in November around 1878. I want to see a significant push above that, possibly even to the high back in May of last year around 1915, 1920. I'd like to see a push up to test that with a reversal back down, put its foot firmly on 1878 or somewhere in that range, and get ready to start climbing the stairs. So that's the only number on the upside I actually care about. Everything between that and here is just noise.
So Rob, with your experience here, why do you think gold is so strong? What's keeping it propped? We've got all this noise, as Miles like to talk about, but what is it that's underlying that's keeping us here?
Well, I mean, you have the commercial banks and the hedge funds, and it looks like there was a lot of short covering a few weeks ago when gold rallied into the 1850s. So I think you've taken a lot of negative pressure off the table, and what that does is leaves a lot of regular people who are buying physical gold. They're not chasing price action. They're just reallocating, upping their percentage of metal in their portfolios. So I do think there is a strong underlying demand for the physical product, like what we have seen. Last year was not an indicator if you were just looking at price action with gold down, 5 or 6%, silver down 14 to 16%. It looked like nothing was happening. We know that's not true.
A lot was happening here.
A lot was happening here, and I'm sure elsewhere. So we know how busy we are and were, and I think that is the strength of this market.
Yeah, central banks in general. We saw India came in with 77.5 tons last year in 2021. That's one central bank. So central banks, David and Kevin pointed out on the weekly commentary, you've got 30-year highs in the central bank holdings, lo and behold, corresponding with the 40-year high in inflation. So the money that's really in the know knows something, and clearly not interested necessarily just in spot price. I don't think they're chasing value. They're looking down the road.
Yeah, you got to love the irony of the central banks who are in charge of Keynesian money printing are stockpiling Austrian gold bars.
Well, I mean, depending upon how you find what our money supply looks like, if you're looking at currency in circulation or monetary base, they no longer report M3 global monetary base. They will report M3 U.S. monetary base. And that alone, in less than 2 years, has increased 39%. So if people are wondering why are things costing more, it's a direct correlation.
That's the correlation. It's got to be. And they know that they're not necessarily going to change directions, or central banks know that the West isn't going to change directions in terms of its money printing, in a sense.
No, we've painted ourselves in a corner. The Fed has no way out. They cannot raise interest rates. I think that we're going to talk about Powell. I just don't think Chairman Powell is that committed to raising rates long term.
A little bit here and there just for the sake of doing what they said they'd do, you think? Or you're saying no rate raise?
No, there's going to be some rate raises, but I think it's mostly to control the narrative and adjust the optic. And definitely the Fed is stepping away from the bond market. I mean, if you look at the 10-year yield, it's at 1.97. That yield 3 years ago?
Less than half of a point?
Well, it was like 1/3 of a percentage point. So interest rates have radically increased on the 10-year. And so bond portfolios are suffering because of that. And so for the quote-unquote conservative investor who's heavily allocated in bonds, they're not doing well.
Well, isn't it funny for you guys to be sitting here talking about bond yields again? I mean, remember 2007 and 8 and 9 and 10? I mean, that was all the talk. And then it lingered even into 15 with Greece. Here comes Greece again. Their 10-year yields all the way at 2.5% in just a very short period of time after being even lower than ours. So something's unraveling. The European Central Bank is removing its stimulus.
Right.
And now their bond market is telling the real story. So these central banks can talk about their Fed or their central bank lending rate. That's not the real interest rate that matters.
No.
It's your 1.97 that you're bringing up,
the yield
Rob.
on the debt. And Miles, show us the chart on the euro with the European Central Bank reversing course from negative interest rates to going back above negative. What's that chart look like?
Yeah, I think this Euro chart, I know we talked about this in our company meeting a couple days ago. I think this Euro chart highlights two aspects of our discussion today. First and foremost, it's the perfect example of what you asked me about with the gold chart. What do we need to see breakout? You need a break above, you need a correction back down, and it needs to put its foot firmly. And that's exactly what we're seeing in the Euro right now.
Yep.
Second of all, and this is what, Rob, you're talking about, look at what the Euro did when they decided to go negative back in 2014 and how the Euro fell off a cliff.
It did.
And as it's been correcting and balancing and finding the sweet spot between the initial panic decline and where it had been prior to that, and we've now moved above its descending triangle, we've put our foot firmly back down on the top end of that, and maybe that old ceiling has now become the new floor, like we talk about. Lo and behold, there's an expectation of raising interest rates again coming out of Europe. Not just Europe, but also out of England, Great Britain. So as you alluded to a second ago, who blinks first? Does Powell blink first? Does the ECB blink first? who's the last guy to pull the gun out of the holster when it comes to raising interest rates? Who's going to stand firm when we all know that raising interest rates without any anticipation of lowering inflation, because remember Powell's speech a couple weeks ago, what comes first? Raising interest rates. What comes second, and I think this is very key, and that's lowering the balance sheet that they're already sitting on.
That is the key.
Real easy to raise rates if you're just going to buy up all that debt.
Yep.
And that's what I'm scared of.
Especially when you see the yields climbing and you're looking for buyers for your bonds.
And
right?
you don't want the stock market to
They do
collapse
not
out
want to
from under
stop.
you.
I mean, who knows if they can taper down to zero to where there's not any more asset purchases.
Not in a midterm year. Is Europe in the face of an election year like we are? I don't think so. I think Powell has to blink if he wants to keep his job.
I mean, he just got reaffirmed. You saw President Trump doing that to Powell. It became a political sensitivity deal, and Congress was really upset about it because he was pressuring the Fed chairman to cooperate, in a sense, to keep the stimulus high on the economy and prop up the markets. And that's got nothing to do necessarily with just even an election year, because that was 2017 and 18.
Well, and I think if you look at the precipitous decline in the value of the euro, I'm going to guess, and you have the chart there, Miles, but I'm thinking it's close to a 50 or 60% decline from where it was when they announced zero and below interest rates to where it fell.
Yeah, you're looking from about 1.4 down to almost 1. So that'd be a 33% decline in a very short period of time. We're talking like a year.
And all the way back in what,
2014, 2015, bottomed in 2015.
Think about that, you guys, how long they've had negative rates and how little impact it's had. Or maybe it's had great impact. Maybe we would have seen
and who benefited? Cui bono? The U.S. dollar.
Yeah.
Because you'll see the dollar climbing as the euro was falling.
That's right.
So if it reverses course, what happens?
And that's the same period of time, despite that, that's the same period of time that gold started to reverse, come around right around the first of 2016.
Was the bottom of December 2015, bottom in the gold market.
Yep. Money starts getting so easy, credit markets expand.
Like all these things are connected.
There you go. Another thing that we're sort of a broken record on, it is connected. You've had a sea change in trade. Despite everything going on COVID-wise, the trade deficit increased 27% last year. 27% to a record $859 billion. We're coming up on $1 trillion a year trade deficit. That was something that was being come against. And I think a lot of that is necessary, you guys, because how else do you keep inflation from really having its full impact at home? If you can't import cheaper goods than what we can produce, then you're not making the public numb to the reality. Well, numb to the reality is importing cheaper goods. And so the trade deficit naturally, politically, is going to increase. And we'll see what's reflected tomorrow. CPI numbers tomorrow. New numbers tomorrow. White House says expect a high number. So we'll see. Is it above the 7%? Well, what about silver? Speaking of inflation, the canary in the coal mine, what is silver doing?
Being that we've been in a bit of a lull, it's a fractal of the larger market. Things in a small term kind of mimic and resemble things on a larger term. So back in 2015, when gold started moving up, silver or platinum, they didn't really start moving till 2018. Well, on an even shorter term time frame, the last year or so, we're seeing the same thing. I mean, gold scraping at the top end of its trading range. Gold looks like there's a reasonable possibility we're going to go ahead and see breakout here. Silver's still at the bottom end of its trading range. Now it is climbing, platinum too. Platinum's more in the middle of the two. So my expectation would be just like we consistently see, gold leads the charge, silver plays catch up with the speed of a rubber band. It tends to snap back very quickly. So that's what we're seeing. And so in the white metals, both silver and platinum, they're lagging behind gold as a percentage of their entire growth. And when they go to play catch up, it will be very quick and violent and very lucrative for the people that are on the right side of that trade.
Silver had the best week this week. The ratio was 80.5. The gold to silver ratio last week. Now it's 78.5 to 1. So 2-point move in 1 week is pretty, even though it's been quiet, that's strong. And it would be nice if that just continued for another 15 straight weeks, right?
2% a week, 30% in 15 weeks. Silver's done better than that before. So ludicrous as it sounds,
that's right.
Silver's beaten it before.
That's right. And that's when you start talking about the portfolios that are set up strategically for ratio trading.
Right. Finally, I do think it's worth mentioning the equity markets because this really is going to be the thing I think that would make Powell blink. Local housing interest rate market is obviously always on their minds because that's where people have the majority of their money. And then the second largest position is in our 401ks and pension plans as far as American citizens go. There's already enough torches and pitchforks out there today. They don't need any more in Washington. And a massive decline in the equities market would cause something like that. So I'm with you, Rob. We talked about this last week. Volcker didn't blink.
Did not.
Greenspan did only when he had to.
Did.
What's Jay Powell going to do? So what's Jay Powell going to do the next time the Dow drops 10,000 points? We're seeing a bounce in both the Dow and the NASDAQ. And Tori, you brought this up a couple weeks ago, the idea that, 5 or 6 companies on the NASDAQ carried the other 100. I mean, it was just abysmal performance by the majority of the techs out there.
Yeah, over half of the techs were in bear market territory already, and people just didn't know. And talking about blinking, I mean, we've got a staring competition right now between the West and the East going on, and particularly centered on the Ukraine and Russia tension issue. And Rob, if it's fair, if I can throw that scenario at you, in times of conflict, let's say that Russia does invade, what do you expect of the equity markets and or gold? And which one moves more in your experience? What would you expect to happen with the equity markets if we break out into a conflict?
I actually think equities would benefit, unfortunately, and so would gold.
All equities, like the indices in general, would start to climb. I see gold. That does make sense. But certain equities or the indices in general?
Unfortunately, history has taught us that war is good for the economy, and that just makes me very sad. But I'll tell you the truth, I don't think Russia really is going to invade Ukraine. I think that Putin is just posturing, and I don't think China is going to invade Taiwan. I do, however, think that Israel has to do something to mitigate Iran getting nuclear weapons. So if one of those 3 hotspots were to pop off, my money is on Israel and Iran, and that's truly frightening.
Any of the 3 really is truly frightening and tragic in a 2022 scenario, unfortunately.
But the Iranians are dead set to wipe off Israel. Israel is dead set to stay around. And I don't see that being mitigated. I don't think either country is posturing. I think that's real.
Well, in the meantime, you see oil over $90 a barrel, firmly above 90.
Yep.
It might be telling more of a story than any other market is in terms of what you're alluding to. So, well, that's going to do it for this week's Golden Rule Radio. As always, we really appreciate you coming back to listen.
If you liked what you heard, you can hit the subscribe button, ring the bell, join us in the comments if there's anything you want to add or for us to take a look at. You can always call and speak with us here at McIlvaney ICA at 800-525-9556. You can find additional info on our website at McIlvaney.com. We're on Twitter at ICA Gold or Facebook at McIlvaney Financial. Thanks again for listening and have a great week.